Often people underestimate the return of physical real estate, saying it's too expensive to start up, not diversified enough, or just hard to manage. Once a good system has been set up, the cash flow will start flowing and you are getting a steady income every month, every year, even if the economy and the markets take a dive. What's up everyone, my name is Joris, welcome back to my finance channel. When you are buying a property, there are several ways to finance it. The most common ways are to buy the property outright cash or take out a loan to pay for the property. Buying cash is the most straightforward option. The return on investment is also very easily calculated. Almost as easy as hitting the like button for the YouTube algorithm. Your net yearly rental income minus all costs and taxes divided by the initial payment. That's your net return. Let's say that you have bought an investment property worth 250,000 euros. To buy it all cash here in Flanders, you will have to pay around 281,000 euros. 250,000 euros for the property itself, 25,000 euros for the registration fees of 10%, and around 6,000 euros for the notary fees. If you then manage to rent out the property for 900 euros a month, your yearly income will be 10,800 euros. For easy calculations, including all taxes and upkeep, I always take about 10 months of rental income to calculate returns quickly. So 900 euros per month, that makes 9,000 euros for the full year, including all related costs and taxes. If your return is 9,000 euros a year and your initial investment is 281,000 euros, your net return is 3.2%. That is a pretty good return on real estate. And the best thing about it, as long as it's rented out, the cash flow will continue to run. Of course, a 3.2% return is low compared to what you can achieve in the stock market. And this is why people often discard the real estate investment as a valid investment option. If the stock market nets over 5% yearly without any effort, the meager 3.2% return of a semi-active investment option is not really comparable. The reason why people will buy property cash is to generate a direct and steady source of income via a rather safe investment. In the last decades, real estate has grown steadily over time, and more importantly, the rental income has also been growing over time. Returns are low, but most Belgian investors see real estate as a sort of safe haven. It's one of the safest ways to generate money. But of course, not everyone wants to or can buy a property all cash. And this is where a loan from the bank comes into play. There's a fine line between needing a loan from the bank to buy a property you need and taking out a loan from the bank not because you have to, but because you want to. The idea behind taking out a loan to buy assets is financial leverage. Remember, assets make you money and thus are preferred to invest in. This financial leverage lets you get the return of the investment of the full value of the asset with limited personal financial input. Of course, some extra costs will occur. If we take the previous example of the property worth 250,000 euros, we'd be paying 281,000 euros to buy it cash and have our yearly 9,000 euros net return. But with financial leverage, we can also receive the same rental income of 9,000 euros a year, but we won't have to pay the 281,000 euros upfront. We are paying it off during the lending period with small payments every month. The good thing here, you are paying down the loan with other people's money. Remember that term, other people's money. The original return on the all-cash property was 3.2%, but let's now include the financial leverage achieved with a loan. Here in Flanders, banks will ask you to put down at least 20% of the value of the property before they will grant you a loan for the rest of the value of the property. This 20% is not very strict. There are a lot of exceptions, but you really need to have a very good and solid case. I have talked more about this in previous videos. Now let's assume a 20% down payment for the calculations here though. So the property is bought at 250,000 euros. You're paying the registration fees, the notary fees and the bank fees, and then you have to put down 20% of the value of the property. So you will have invested 85,000 euros. The other 200,000 euros will be the loan from the bank. 85,000 euros invested instead of 281,000 euros, That's quite the difference already. Having to put down less will also allow you to buy the property quicker and just pay the rest of the value of the property over time. Interest rates are extremely low, so you're not paying a lot in interest anyway. And on top of that, the interest rates are often below current inflation levels, which means that over time you're even paying off less than you would be paying if you're paying it all right now. Remember, due to inflation, €1 today is worth more than €1 tomorrow. So it's better to pay off the mortgage over time than to pay everything right now. Once the loan is in place, you have invested €85,000 in the property, and the rental income can then start coming. We work with the same calculations as before, so 10 months of rental income. Of course, when you take out the loan, you'll still have to pay off the loan over time. When taking out a loan of €200,000 over 25 years at an interest rate of 1.5%, you're paying off €798.86 every month. Or let's just say €800 for easy calculations. That is €9,600 per year. If we then compare that yearly mortgage payments to the rental income minus the yearly costs, we would pay €600 every year for the property. A negative cash flow of €600, but of course we are also paying off the principal of the property. In the first year, you're paying down around €6,650 in principal and €2,950 in interest. And the principal is also a return on your investment. Paid off principal adds to your net value over time. Apart from that, we can also take the rise in real estate prices into account. A very defensive approach here is to take a growth of 2% every year on the full value of the property. 2% of €250,000, that is €5,000 a year. If we then paint the full financial picture, we have invested €85,000 in the property, we have a yearly net cost of €600, that is rental income minus upkeep, taxes and mortgage payments. We have the yearly paid off principal of €6,650, and we have the yearly appraisal of the property of €5,000. If we then add everything up, that is €85,600 invested after 1 year and a return of €11,650. That is a return of 13.61%, a net return with all direct costs included. Of course, not every year is exactly the same, and some years you'll have a lot of upkeep and in others you won't have any upkeep. A nice addition here is that the rent should also be adjusted to inflation every year, and the principal payoff will also go up every year. These two options will boost the return over time. As you can see, the addition of the financial leverage, as in a mortgage, will boost the return on your investments. We went from the initial 3.20% with a cash property to 13.61% with a mortgage loan and a down payment of 20% of the principal of the property. That is a huge difference. 13.61% is also quite a bit higher than the average stock market returns. It does take some time managing your property, but the difference in return is probably worth it. There are also a lot of ways to boost this return even further, and we will address them in a future video. If you have enjoyed this video and you are interested in the next one, please leave a like for the YouTube algorithm, subscribe to the channel and hit the notification bell so you will be alerted when the new video comes out. If you can't wait until then and you want to watch more of my videos right now, you can start by clicking one of them right here. I thank you very much for watching and I will see you in the next video.